Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. My name is Desmond, and in today's podcast, we're tackling a critical topic that can make or break your trading experience: leverage and margin. These tools can amplify your potential profits, but they come with their own set of risks. So let's explore how leverage and margin work by breaking them down into 4 main points and how to use them effectively without falling into common traps. Number 1, understanding leverage and margin. Leverage is a powerful tool in Forex trading, allowing you to control a large position with a relatively small amount of capital. In simple terms, it's like borrowing money from your broker to increase your trading exposure. For example, with 101 leverage, you can control a $100,000 position with just $1,000 of your own money. This can magnify your profits, but it can also amplify your losses. Margin, on the other hand, is the amount of money required to open and maintain a leveraged position. It's essentially a good faith deposit that ensures you can cover potential losses. The higher your leverage, the smaller your margin requirement will be. However, this also means that small market movements can have a big impact on your equity. Number 2, leverage strategies. To use leverage effectively is crucial to adopt best practices that prevent you from overextending yourself. Here are a few strategies. Know your limits. Determine how much risk you are comfortable taking and adjust your leverage accordingly. Avoid using maximum leverage as a default setting. Use stop-loss orders. Implement stop-loss orders to protect your capital from significant losses. This will automatically close your position if the market moves against you beyond a certain point. Focus on risk management. Allocate only a small portion of your trading capital to each position. This way, even if a trade goes wrong, it won't jeopardize your entire account. Number 3, margin calls and how to avoid them. A margin call occurs when your account equity falls below the required margin level, prompting your broker to request additional funds to keep your position open. If you can't provide the extra funds, your positions might be liquidated, potentially locking in losses. To avoid margin calls, monitor your trades closely and ensure you maintain sufficient funds in your account. Regularly review your positions and adjust your leverage based on market conditions. It's also a good idea to keep some buffer capital to cover unexpected market movements. Number 4, real trader stories. To put things into perspective, let's look at a couple of real trader stories. Story 1. John, an experienced trader, used high leverage to capitalize on a trending currency pair. While his initial trades were profitable, a sudden market shift led to significant losses. Because John hadn't set adequate stop-loss levels and was using high leverage, he faced a margin call that wiped out a large portion of his account. Story 2. Sarah, a newer trader, started with conservative leverage and gradually increased it as she gained more experience. She utilized stop-loss orders and regularly monitored her account. By managing her leverage carefully and keeping an eye on her margin, Sarah was able to avoid margin calls and maintain steady growth in her trading account. In conclusion, leverage and margin can be powerful allies in Forex trading, but they require careful management and a solid understanding of the risks. By knowing how they work, employing smart strategies, and avoiding common pitfalls, you can use these tools to enhance your trading without falling prey to their dangers. And that wraps up today's discussion on leverage and margin. In the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.